morning class. Today we're going to look at insurance claims. In the previous video, in the previous class, we've looked at insurance in introductory manner. Today we're looking at claims, and we will look at the procedure that we need to follow for the calculation of claim for loss of stock. So first, we look at the gross profit ratio. Now this is determined on the basis of gross profit ratios of earlier years. So you can use either the average of gross profit ratios of the earlier years. Okay, so if you're looking at maybe 5 years, then average of those 5 years, or you can take a weighted average of those earlier years. Now, if the gross profit is showing a trend, okay, maybe if the gross profit is increasing steadily over the years, over the past years, or if it is steadily decreasing over the past years, then that trend will have to be considered while you are calculating the gross profit ratio of the year of the fire. All right, so that needs to be considered. And in all of this, stock needs to be valued at cost. Okay? Stock needs to be valued at cost. And abnormal items are excluded, and normal gross profit ratio is calculated. Next, we look at the information for trading account. So information such as the opening stock purchases, sales, direct expenses, right? These are taken from the balance sheet. Okay? Then if the balance sheet is destroyed in the fire, then you will have to look at the purchase bills, sales bills, vouchers, statements from debtors and creditors, bank passbook, and correspondence with parties. So you'll have to try to gather this information from either the balance sheet, or if the balance sheet is not available, if it is destroyed, then from these other sources. So now after gathering those information, we will look at the memorandum trading account. All right, so we use the information from step 2. Okay, and we use the gross profit ratio that we found in step 1. Okay, this is not gross print ratio, this is gross profit ratio. And after all the calculation, the balancing figure here at the bottom is the value of the stock at cost on the date of fire. All right. So in all this, we will make sure that the opening stock is valued at cost, and this is the pro forma. You have opening stock at cost to purchase less the purchase returns. Then you have direct expenses. Then you have the gross profit. On the credit side, you have buy sales less the sales returns. Then buy goods distributed as free samples or drawings during the particular period. Buy stock on the date of fire, and this is the difference, or this is the balancing figure. All right. Now next we have next we have the claim for stock loss of stock. So here, if any abnormal stock is there, then it is mentioned here. Okay, so if any of the stock is affected by the fire, then you have that. All right, so this is the statement of claims, value of normal stock on date of fire, and if any of those are affected by fire, it becomes the normal stock, and that is mentioned here. Total stock on date of fire, that is expenses, you will add the expenses. Right, so you have the total stock on date of fire, and to this amount you will add the expenses to mitigate loss. All right, so all the expenses that you've incurred to reduce the loss of any of your goods, then the salvage stock. All right, so maybe it's burnt out, and then at least there's some scrap left that you can sell. So after you subtract that and you add the expenses, then you have your total amount for the claims for loss of stock. All right. Now there's something called the average clause. What is this average clause? This is to discourage underinsurance. Okay, so usually you'll have an amount, okay, the policy amount, and sometimes the loss that you have is less than the policy amount. And in this case, we will use this formula. Okay, amount is equal to loss of stock into policy amount divided by value of stock on the date of fire. All right, so we'll be using this formula. Okay, an example of that formula is, supposing the value of stock is 4 lakhs, salvage value is 1 lakh, and the policy amount is 3,20,000. Okay, so loss of stock is how much? Loss of stock is 3,000. Why? Because value of stock is 4 lakhs. Sorry, this is 3 lakhs, right? Loss of stock is 3 lakhs. Why? Because the value of stock is 4 lakhs and the salvage value is 1 lakh. And so when you subtract that, you get 3 lakhs. Okay, that's the value of stock less the salvage value. All right. Then next we have policy amount. Policy amount given here, 3,20,000. So 3,20,000. Okay. Then value of stock on the date of fire. Value of stock is 4,000. So when you calculate this, you get 2,40,000. So this average clause is applicable when we are having underinsurance. Okay. In case of overinsurance, it is treated as full insurance because the full amount is covered. All right. So the policy amount is 3,20,000, right? But then the claim does not reach that amount, so we will have to use this average clause formula. In case it is overinsured, then it will be treated at full amount. Next, while preparing trading accounts of earlier years, if stocks are under or overvalued, then they are brought to cost price, right? So they are making sure that there is nothing that is undervalued or overvalued. Okay, so we are looking at cost price to make that adjustment. So this is to make sure that the gross profit is consistent. Okay, so even the sales at higher or lower value are also adjusted, and free samples, write-off, etc. are also adjusted. And so change in sale price and cost price during the year of fire and earlier also should be adjusted to calculate correct gross profit. All right, so the final point is to make sure that everything is adjusted so that you have a consistent gross profit, all right, and everything is valued at cost price. All right, so these are the 6 points you need to consider while looking at insurance claim. All right, this is the procedure for calculation of claim for loss of stock.